All right, we're getting a show on the road. Hello there. I'm Mitch Goldberg. You're watching my live stream, Be the Boss of Your Money. Couple of important things to talk about today that will help you understand what's taking place globally in the markets. We had a pretty big rebound on Wall Street today. It certainly affects everybody on Main Street. The value of your portfolio has gone up nicely today. Doesn't make up for what we've gone through the last, month and a half, but nonetheless, we finally had a decent bounce, something to write home about. So we're going to talk about that. There's four key points we're going to make today. One of them is a dire warning uh, that things are going to get much worse, and it comes from somebody with a track record of calling really bad things for markets. So we're going to talk about that. Um, and then we're going to talk about why the market went up today. Oil went down, stocks went down. People believe with oil going down that the worst of inflation could be behind us. We're getting ready for the Federal Reserve to raise interest rates on September 21st. That's the second day of its next meeting. It's having a 2-day meeting, the 20th and 21st of September. Almost 90% odds, according to the odds makers, that the Fed raises rates 0.75%. I agree with that. I've said so already, but it doesn't matter. It's the direction of interest rates that we're looking at. And we're going to talk about a few things. This is Be the Boss of Your Money. It's all about helping you become your best financial version of yourself. And it's where we put the personal into personal finance. Why? Because everybody's different. You are unique. While you're watching, give us a thumbs up if you like the content, if you like the way the show is going, a heart, an applause, a wow, whatever reaction is available to you depending on which social media platform you're watching. When you give us a like, it helps spread the word to your contacts and everybody else out there. It's good for the algorithms, the social media algorithms, and it helps spread the word about the good work we're doing here to educate you and to really help you stick to a plan, which ultimately we know is going to help you the most, as opposed to darting in and out of markets every time you get scared about something in the economy or in the world. So that's what we talk about. We're going to roll a quick intro. We're going to throw in a banner here also. And then we're going to talk about these things. If you have any questions, either about what we're talking about now or, something that you'd like to know more about, certainly hit me up in the comments. I love hearing from you. It's the best part of doing this. And with that said, here we go. All right. Thank you so much for joining me. Jesse, I see you out there. I see Jesse Viola. Thank you very much for the thumbs up. I'm hoping one day you and I could still get that collaboration going. That would be a lot of fun. Jesse is a content creator on Long Island, one of those really cool guys that brings the whole, you know, Brooklyn, Williamsburg kind of vibe uh, to Long Island, and we love to see that out here in the burbs. All right, so let's talk about the markets today. We'll jump right in. Okay, I put myself up here. First, let's take a look at how the overall markets did today. The Dow up 1.4%. These are good numbers. Nasdaq up over 2%. S&P up almost 2%. Gold up a little bit, but the big news is oil. Oil down to 81, down $5 a barrel. That is a significant drop. And for all those people, I still don't get it, who are calling for $150 to $200 a barrel. I don't think it gets there. Not anytime soon. We've always said this on the show here. The cure for high oil prices is high oil prices. And that's what happened. People cut back, drillers drill more, supply demand balance. Well, supply and demand falls more into balance and prices go down. 10-year yield was off slightly. That's about the whole yield curve. We'll go over that in a moment. And the VIX was off a good amount, down 8.5%. See that? Okay, right there, down 2.27 down to 24. Let's take a look at the bond market. This is going to get substantially significant quickly. The 2-year yield was off a drop at 3.43. It was 3.5%. The 10-year at 3.269. The gap between this, the 2-year 3.437, and the 10-year 3.269, the gap between those two numbers is not as wide. It's called an inverted yield curve. You would expect the 10-year yield to be higher than the 2-year yield. It's not the case now. That's why we call it an inverted yield curve. He's been a little stuffy today, but it's significant because the yield is starting to tighten a little bit, and maybe that's a bullish sign for the Fed to not raise rates as much. Let's just see who's out there. Jesse says, "Hey, Mitch. Hey, man. Good to see you. Thank you so much for joining me. I really appreciate that." And yeah, man, we got some good things to talk about. Okay, so let's talk about a dire prediction. Before I really dive into this, I just want to warn you that there are so many predictions about where the market's going to go. We're going to go back to new highs by year end. The market's going to set new lows by year end. The predictions are all over the place, and there are some pretty good mathematical reasons for each one. I don't like to go by strategists who make firebrand, fire and brimstone calls that say we're going to just plunge, we're going to fall off a cliff, the whole world is going to be over, we're at the end of a super bubble. Yeah, there was a time when stocks were trading at like 10 times earnings on average. I don't think we get back to those times. It's just times are different. And we have better companies, more technology. So, and then, but the people calling for new record highs by the end of the year, look, if I told you that the Dow could be up or down a little bit from where it is now, or the S&P 500 or the NASDAQ, oh, by the way, I have to say this. You know what I'm about to say, right? You can't invest directly into an index, but you could invest into a security that tracks or mimics an index. I could say that in my sleep. Look, if I told you that the S&P 500 or the Dow or NASDAQ, well, they'll finish the year about a little more or less than where they are now, I don't think you'd really pay attention. I don't think the media is going to pick that up because it's not exciting enough. It's the big calls like, yeah, we're going to go to 5,000 in the S&P 500, or we're going to go down to 2,000 in the S&P 500. Those are substantial calls. Those are the kinds of calls that make headlines, that get attention, that either juice you or scare you into doing something. Okay, I don't really like to get into the hyperbole. Now, maybe somebody will be right. I mean, if enough people make a call of where the markets are going to finish between September and December, well, yeah, if enough people make a call, somebody's going to be right, and they'll be hailed as a superhero until you realize that they can't make that same good call again and again and again. There's no consistency to it. So when I say there's no consistency to it, it's a good segue to get into this next call where Michael Burry, hedge fund manager, who called the subprime crisis and shorted mortgage bonds, mortgage-backed securities, I should say, made a fortune. He's now calling for another dire, crusher, killer, horrible market that's going to take us all apart, maybe even put me out of a job, right? I've seen pretty tough markets before, and no one's been able to put me out of a job yet. I just want to say real quick shout out, the man, Mr. Buckley. Happy birthday, Buck. I hope you had a great day, by the way. And thank you so much for joining me. So I'm going to pull up what this guy says. The Big Short, Michael Burry. Oh, let me put this on the screen. All right, here I am. I'll be with the corner. Hello, Michael Burry. Hints. We are in the middle of a market bubble popping akin to the '08 market and the 2000 market. Those are the last two monster, retreats. The S&P went 50% lower. We're about 16% lower from peaks. Okay. The big short investor Michael Burry, best known for calling the subprime mortgage crisis, issued another dire prediction in a cryptic tweet hinting, okay, at 2000 and 2008 style market bubble could be on its way. All right, so crypto crash check, meme crash check, SPAC crash check, inflation check. 2000, 2008, 2022, all checks. And what he means by this is that first, you're seeing the most speculative stuff get killed, and people migrate toward what they think are the more stable, safer, better places to be, which are large cap stocks. So as crypto goes down, people hold on to the S&P 500 stocks, right? Meme stocks, fine. But first, I don't even want to compare meme stocks and crypto to the rest of the stock market. I think it's kind of silly. But what he's saying is that you had such a speculative froth in the overall market that crypto and meme stocks were a symptom of how investors got carried away with risk and paying up for assets that had no business being as expensive as they were. And eventually, now inflation's up. He says the rest of the stock market's very expensive, like the S&P 500, and that's got to correct also, and it's corrected only modestly compared to his expectations. So he expects a substantially down market. And then he says in another tweet, no, we have not hit bottom yet. Watch for failures and look for the bottom. 2 SPAC ETFs failing is not near enough. I'm not aware of SPAC ETFs that failed today, but I'll take a look at one right now. I'm just going to pull up a quote. There's one that I have spoken about on my live stream. What do you mean? Wow, what the hell happened to this one? That's the Defiance Next Gen SPAC dividend ETF. We talked about on my live stream, and I said this is something really that I'm not excited about. This is not something that I would want my money in. You do what you want. It's just extraordinarily speculative. And just because you take a lot of speculative assets and put them into one combined portfolio and you go, oh, well, it's a diversified portfolio, taking one piece of junk and mixing it with like 20 other pieces of junk does not create a diversified portfolio. It creates a pile of junk. But there's no quote on it. So what the hell happened to this? Anything? This is just, this is all sponsored content. I have to look into this, but maybe this is the one that he says a SPAC ETF failed. Wow, that's interesting stuff. So let's get back to what he says, okay? At the end, Jeremy Grantham, who's known for calling tough markets, says, we haven't even seen anything yet. There are there's a huge asset bubble right now. It's just begun to pop, and asset prices are going way lower, way lower. Okay, so let's talk about some of the risks. And like I said, I don't want you to vomit, and I don't want you to make a call on your own investments, your own retirement funds, because one person makes a dire call. There are millions of people making big calls, and there's a chance that somebody is going to be right. The odds of somebody being right and then being right, again and again and again, is extraordinarily low and very unlikely. But a couple of things. Let's just talk about this real quick. I just want to see who's out there. Wendy's out there. Hey, Wendy, good to see you. So a couple of things. A few. How do I say this? Here's what I'm dealing with this. Okay, I want you to know I'm not into making changes in people's portfolios just because of the market. Okay, well, the market's down, you should be selling everything. The market's up, you should be buying everything. It's not really how I make my decisions. What I would tell you though, if you're worried about the market, and I'm actually somebody who believes there's always something to worry about. There's always another worry around the corner. All right, yet stocks have historically always managed to go to new highs, but lengthen your time horizon. If you bought stocks because you think you'll be out of them with big profits 6 months, a year, 2 years, you may need to think about lengthening your time horizon. You might need to think more in terms of 10 years out or more. And if that's your time horizon, whatever we're talking about now becomes much less relevant. In fact, it becomes irrelevant. So if you're doing it right, what we're talking about here should be irrelevant. You shouldn't even be watching. But we don't have a great concept of time as humans until we have very little time. Then we have a really good concept of time. And you have less time as you get older, which means you have less time to make money and more time to worry then about not having enough money for retirement. So you really need to have an extended time horizon. Another thing, they say generals are always fighting the last war. And what I mean by that, applying it to the stock market, is I think one of the biggest risks we talk about here on the show, and you've already heard this, I apologize, but there's some new people. One of the biggest risks in every bull market are that investors are always run back to the winners of the last bull market. And you see how stocks like Nvidia and Meta, which used to be called Facebook, stocks like those two keep getting crushed. And investors keep running back to them because they think that, they were the winners last time. They're just down. They're bargains. I'll buy them now. And they keep going lower after you buy them. So what I mean is investors are always trying to, win again by buying the last bull market stocks. And very often we get a new crew of winners that takes us up. So I can't tell you for sure if the winners of the last bull market are going to be the winners again of the next bull market. But history is not on your side if you were to bet that last bull market's winners will be this bull market's winners. So that's why it's important to diversify, to make sure we don't have too much money in the last bull market's winners, which often become the big losers of the next bear market. All right. Diversification is a strategy, as you know, that we use to mitigate risk, but it doesn't necessarily protect your portfolio from going down in a generally down market. So I just want to make you aware of that risk, that just because stocks were big winners in the last bull market, there's no guarantee that past performance is an indication of future performance. And quite often we have new winners, but investors make the mistake of keep buying and averaging down and more averaging down and more averaging down, buying lower on the old winners. And I've seen a lot of people lose a lot of money doing that. Okay. This past weekend, I hope everybody had a nice Labor Day weekend. For me, it was a great weekend. I saw so many friends, and it's just a beautiful weekend. But it ended at my fourth barbecue of the weekend on Monday night. I'm at my friend Susan's house, and people are talking about the market. And generally speaking, when people hear that I'm a financial advisor, just a humble brag. Some people already know who I am because, media, okay. Humble brag. Oh my God. Put the ego back. Okay. So anyway, they talk, they ask me things like, well, what do you think of Meta, the old Facebook stock? Do you think that'll come back? What do you think of Amazon? I like Amazon because it's split 24, and one person's like, oh, I just sold this. I made all this money in one stock. Not telling me about any of their losers, just their winners. I'm very suspicious when people tell me that they made money in this stock, they made money in that stock. I'm like, oh, it's good that you never had any losers. And if people do that to me all the time. And then they ask me, should they buy this? Should they buy that? My answer is, it depends. It depends. It depends. It depends. 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 Should I buy this? Should I do that? And then one person says, "Oh, I'm just waiting until the market bottoms out and goes back to the June lows. Then I'm going to buy." Well, if you didn't buy the last time the market went down to its June lows, you're not going to buy again if the next time the market goes down to those previous lows, because then you're just going to wait for the market to go even lower. And then when it goes back up, you're not going to buy because you could have bought lower. And it just becomes an endless cycle of procrastination. Okay. And another person says, "I don't trust anybody with my money. I pick all my own stocks. I do this, I do that." I mean, this person's the egos are so huge, and it's like, based on what? They just buy what's popular in the news. They tell you about the winners. They don't tell you about the losers. So I'm very wary of that when I go out. People are always doing that, and they're asking me, "Do you think the market goes up? Do you think the market goes down?" My answer is always, "What's the difference? What I think." As long as the money you need over the next few years is already set aside in cash, you don't have to worry about this, because we have no control over the market, but you could control whether or not you move expected cash, expenses, future expenses into cash. That's something you could control. Having an emergency fund is something you could control. That's what's important. The rest of it is long-term money. I'm confident in saying you'll do well over the long term. I'm confident in saying individual stocks don't always recover. Time does not heal all wounds, but the indexes, i.e., index funds, they've always recovered. So, what kind of investor are you? And if you're asking me about Amazon, why? If you just want to own Amazon, that's your goal. You could buy one share, and you've met your goal. What's the point of owning it? It depends on the goal. Depends on the risk tolerance. So that's what I tell people. And they're like, "But you're a financial advisor. Should you be telling me what to do? Don't you tell people what to do with their money?" And my answer to that is, I spend more time telling people what not to do with their money. And I pretty much get out of the conversation. "Nice to see you. I'm just going to go say hello to so and so, or I'm going to, get more coffee. Excuse me." And I just want to extricate myself from the conversation, because this is what people do. Don't be one of these people, is what I'm saying. Okay. Next thing. We talked about lengthen your time horizon. We'll talk one more thing about the Federal Reserve. Federal Reserve governors today of different Federal Reserve branches are talking, saying they really want to see inflation come down, and they want to see it stay down for some time. So I think this whole business of, the Fed suddenly, seeing the light, waking up in a cold sweat in the middle of the night and saying, "Oh no, I have to lower interest rates." I don't think you're getting that so fast. I think we're going to see a slow bleed, some upticks to pull you back into the market. The market goes down again. And after this happens a bunch of times, that's when you're finally going to get sick of it, throw in the towel, and that's when stocks will be ready to buy. What else am I looking at? So if we were looking at stocks, the Federal Reserve raising rates starting here and getting to here. In June, we thought here's the middle. They went past the middle. We could see the light at the end of the tunnel, the end of the Fed tightening cycle. But now the cycle has been extended. So if the Fed went from here to here, now they have to go. My hand's not even on the screen. They have to go all the way out here. So we've got a much longer time to go. And I think that's what people have to understand. So we're going to see a lot of fits and starts. If you're a long-term buyer, you're investing in your 401k plan every month, this is a gift for you, lower prices, right? Lower prices. You hear about all these people who made all the money in the market buying when the market was down. They did it in times like this. If you're looking to just throw money in the market now and get a really good return over the near term, I think this is going to be very difficult for you. Not impossible for everybody, but for the overwhelming majority of you, you'll be wasting your time. You'll be wasting your money. And if your time horizon is really not that long, I would say don't even bother. Just leave your money in the bank. Count your money every day. All right. So that is it. That's the story for today. I hope you found the show to be interesting today. Thumbs up if you will. Some kind of reaction on social media. Share it with your friends. Leave a comment. Say hello. Ask me a question in the comments. you know, words of encouragement are always appreciated. Lessons learned. That's it. Buckley, good to see you, man. All good, brother. And I'm going to end it now. I'm going to end the show, okay? And I'll speak to you guys tomorrow. Thanks so much.